John Robinson. He's going to discuss with you the basics of how to grow your money. Make sure that you're focused, that you have a sheet of paper, a pen, or your phone handy to take good notes. Equity partner, John Robinson, has over 20 years in the financial services industry, and he cares about his community. And so just know that all of the information that he's going to share with you guys tonight, it will definitely be beneficial and you will want to pay attention. So, without further ado, I present your presenter tonight, Equity Partner Business Director John Robinson.
You ready? Let's go. Yeah. For those of you that want to know what we're all about.
Good evening. Good evening. It's good to see everyone this evening. I'm excited about bringing this information to you. I always love talking about money and how to grow money, how to keep your money, how to make more money. But we're gonna be presenting the very, very basic information on how to grow money. My wife and I are in business for ourselves, and we're excited about being able to bring this information to you. Let me make sure I'm in the right screen because I got about 6 screens all over the place here. And let me stop sharing. Let me reshare. Make sure I got the right one. Yep, I got the right one. So here we go. Here we go. We're going to talk about how to grow your money. Just the basic information about how to grow money. Once I started studying money a few years ago, I come to realize that we were not losing the money game because we didn't understand the great complicated stuff. We were losing the money game because we just didn't understand the basic stuff. And I believe, and we believe here at OIC 10K very strongly, that if we can get the basic financial knowledge in our community, we can eliminate poverty that way. So let's get started here. And just like my host, business director Erica Bass said graciously, just a little basic financial information can make all the difference in our decision-making process. So I'm going to see these light bulbs go off in your eyes as I talk about this stuff, just like it did in my eyes. And some of the things we just didn't know we had a choice, but we do. So let's get going here. All right. So what are the basic programs that people use to accumulate money or to grow money or to save money? We know about savings account. We believe in savings account. We believe in bank CDs, and we got the 401ks and the 403bs and 457 and the 403, and we got the Roth programs and stock market, and we do day trading, money markets, bonds, and even permanent life insurance. And these are all great programs, great instruments. But let me just share this with you. Growing your money can be broken down into 2 basic components. One is the financial instrument or the program that you're going to use. I make fun of it all the time. First time I heard someone talk about financial instrument, I'm thinking, I wonder if their child is in the band and they need to finance this instrument or something. I didn't know what was going on. But, that's not something that we commonly talk about. It should be a common part of our language, but it's not. But financial instrument, what instrument are you using? And we're going to talk about those here in a minute. And then where or what environment are you going to use to grow your money? Where is this instrument? Where is it operating? What environment is it operating in? It's going to be very simple. You'll see what I'm saying. So let's move on here quickly. These are some of the financial instruments that most people know about or maybe haven't even heard about. But we know about savings and check-ins. I had one friend of mine says the first time he saw a sign in the bank that said CDs, he was wondering what's going on. What kind of CDs they selling here? He was thinking about a music CD, you know. But you got the CDs, and then of course you have your mutual funds, and then of course there's stocks and bonds and treasuries and all the stuff. And then you have, of course, your IRAs, your individual retirement accounts. Then you got your 401ks and 403bs and all these different programs, variable annuities, fixed annuities, savings bonds. You got your Roth programs, your life insurance programs. So these are different financial instruments that people use to accumulate money, right? You heard of some of these, right? Or most of them. All right. So let's move on now. Those are the instruments. Now, the environment. Let's talk about the environment. There are basically about 3 environments out there. All right. You got your fixed, you got your variable, and you have your index, right? So let's break it down. Your fixed environment is like your banks, you know. You put your money in there, they'll give you 1.5%, 2%, 0.8%, whatever the lowest percent they can give you so they can make money off of your money. So right now, there are few bold banks because the interest rate is up so high that they're willing to give you 2% or 3%. 1 or 2 programs out there or companies out there have a 5% interest on your savings account. So credit unions are great institutions also, but for the most part, you put your money in there, your interest, your growth is fixed. Whatever it is that they declare it to be, that is what it's going to be, right? And then you have all the fixed interest programs, maybe an annuity, they say, or a life program that says we're going to give you 2% on your money, 3%. So that's a fixed situation. Challenge with the fixed situation is they're usually not much growth. They're just usually not. So that's your fixed environment. Now your variable environment, your 401ks, your 403bs, 457bs, you know, other pension plans, variable annuities, variable universal life programs, and others, they're in this variable environment. What is variable environment? The market, stock market, right? So as the market goes up, you make money. As the market goes down, you lose money. So it's up and down and up and down. And so what most people hope is that they have more ups than downs. And then they hope that when they get ready to retire, it's not just after the down. They hope that they can retire with most of their money before it goes down. So, you know, that's one way to try to accumulate funds. And that's up to you if you want to do that. Now, index environment. Some of the same instruments that were in the other program on these programs also, like your 403bs, your 457, and a few 401ks, not a whole lot. For the most part, your 401ks are variable. But, you know, some of the other instruments, they're variable or they can be indexed. If they can be either or, that means what? You have a choice. That's what that means. I didn't know we had a choice as to where we wanted to grow our money. I thought that was it. And that's it. That's what they say, and that's it. No, you have a choice. Like I said, very few 401ks or index. I've heard about maybe 1 or so. But for the most part, that is variable, and that's why I didn't put it up front there. Index annuities, index universal life programs, these programs are indexed. Now, what do I mean by index? So the index programs or programs where, like, you have a group of companies that come together and your money, they form this big index. You have several indexes out there. And I should have definitely had a slide of that. So you could see some of the index markets, like S&P 500, you got your Credit Suisse, you have your global and local programs that are indexed. So your money is never directly in the market, but it kind of mirrors the market and it benefits from the movement of the market. And so the thing about the index program is this, you make money as the market goes up. Your money goes up, you earn great interest, but when the market drops, your money doesn't drop with it. So let me say that again. You earn money as the market is up, which is great. The market is up, it's doing great. I've got clients that earn 13%, 16% on their annuity programs this past year because the market was up, right? And but when the market drops, your money does not drop like with the variable programs. See, this red line represents your money. So that going up mark is great. But when it drops, it can drop pretty deep. And they tell us all kinds of stuff. They say, well, don't worry about when it drops. Your money always comes back. Yeah, the market always comes back. This is true. But your money never comes back. The money you lose is gone. That's just the way that is. And I know we've heard that, most of our working lives, it comes back. And we have the illusion of thinking that it does come back. But let me ask you this. If you start your account at the beginning of the year with $50,000 in your 403B or 401k or wherever it is that's in the market, and at the end of the year, you have $40,000, how much money did you lose? And most people will say, I lost $10,000. Well, that's not true at all. So if you start with 50,000 and you end with 40,000, yes, you lost 10%, 10,000 from that 50, but you also lost everything you put in that year. What about that money? Where did that money go to? Right? And then the interest from that money that you should have been earning, that's gone too. So you lose a whole lot more than $10,000. And then they say, well, don't worry about it. It'll come back. Does it really come back? Or your $50,000, you receive $50,000 in your account again if you keep putting money in and the market picks up and the money that's there grows some interest. So now you're back to 50 and you feel good because you feel the money came back. It didn't come back. You put some more money on it, you earn some more interest, and yeah, I felt the same way. I said, I can't believe I fell for this all this time. And this is very basic. And this has nothing to do with your ability to add and subtract. Most people go to work to do a good job and to take care of their family. And we trust others to do their job properly to help us navigate some of these areas that we're not familiar with. But sadly, a lot of times they're just doing a job and want to get it done quickly and don't really consider all the things that we should know. So this is what the variable market looks like. Your money goes up and down with the market. I had a friend of mine, an associate, that she was a petrochemical engineer with one of the big oil companies in town. And she was getting ready to retire in 2008. She had $1 million in her 401k. And that $1 million in 2007 dropped down to $500,000. So she had to end up working another 5 years to be able to get to the point where she could retire. Nowadays, we're working longer and longer. You know, they push back the retirement age. You used to be able to retire on 100% on your Social Security at 65. Now they pushed it back to 67. I hear rumors about them talking about pushing it back to 70. I don't know. But if you work to 70 and you lost a third or a half of your retirement money, would you have another 5 years in you to work and build it back up? That's something that we want to keep in mind. So that's the variable market, index market. You grow your money in there. You could use a 403B, 457, or an index annuity, or an index universal life program. Programs that say, okay, I want to grow money, but I don't want to lose money. I want to grow my money, but I don't want to lose my money. And that's something that we have to think about. You got to think about that. And you know, we really didn't know that we had choices, right? But you must understand this. With a little financial knowledge, you now have a choice. So now when you meet with an agent and they want to talk to you about a 403B program or a 457 program or an annuity, and they want to tell you how great it is, now you get to ask them, is this variable or index? And if they say, well, it's a variable program, or if they say, what are you talking about? You tell them, go find out, or you come talk to us. Because now you can decide if you safely want to grow your money, you safely want to grow your retirement savings, or if you want to gamble with your retirement savings. And that's your choice. Personally, I believe if you're going to gamble, you should go to Vegas. You may win or you may lose, but either way, you're going to have a good time. But I don't understand being at work, working hard, doing my part, and losing money in my retirement savings. I didn't have any fun. I didn't hear just see no lights. No ding, 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 ding. I didn't hear nothing. No shows, no buffets. How am I going to lose money and I didn't have any fun? So, you know, we get to decide what we want to do now. We get to say, wait a minute, that program sounds good, but I want to know, is it variable or index? I need to know. And do you have this option in an index program? If we had a little more time, we could really deep dive into this and not only talk about the type of interest that you can earn in these programs, but we could talk about things like participation rates. We could talk about things like bonuses. A lot of these programs have a bonus that they'll give you for saving or putting your money with them. A lot of these programs don't only say, well, yeah, we're going to have you in a protected environment where your money can grow and you will earn whatever the market does, but some of these 100% of what the market does. In other words, if the market does 5% and you have a 200% program participation rate, now your money earns 10% instead of 5%. There's a lot more to it. So the thing about it is, just to understand in the beginning that we have a choice. You no longer need to sit there and just let them present and say this and we're going to do that. Now you can ask some educated questions. Where am I going to be growing this money? Is it going to be in a variable environment or is it going to be in an index environment? Am I going to have some protection for my money or que sera, sera? Does that make sense? You should want to know, because That's what's important here. So keep that in mind. You can safely grow your retirement savings, or you can gamble with yours, but that's up to you. So listen, guys, I want to thank you for allowing us to share this information with you. And we look forward to seeing you guys again. We'll be back together here on Thursday. And I'm excited about bringing this information and many other financial topics to educate our community. I want to turn it back over to my host, Ms.